Good morning, everyone. Thank you for joining. I'm going to get started with a few announcements. So just to start off, thank you for joining. The slide deck can be found in the handout section on your webinar toolbar. And please use the question section on the toolbar as well throughout the presentation. We'll be holding all questions for the end pertaining to the presentation. And we understand that we may not cover them all during the Q&A section, but we plan to respond to all and send via email to all attendees. So please bear with us. We're also going to be sharing the materials and the presentation video link following the live presentation. And I'll turn it over to your presenters.
Thank you, Allison. My name is Dan Mayo, and I'm a principal in the National Tax Services Group here at Withum. I also want to introduce my co-panelists. We have Barry Horowitz and Jim Bartek, who are members of the state and local tax team, and Frank Boutelet, who is a financial services partner, and he's going to be covering some of the SBA loan issues today. So very briefly, today's agenda, we will cover the federal updates, tax, and some business points. Then some state and local tax updates, and then finally, as I mentioned, Frank is going to cover business loan assistance, SBAs, and how the new legislation and what it's going to do and how to apply for the SBA loans. So we're going to start today with the extension that was announced by the IRS. There was a little bit of back and forth with this extension, so I just thought a brief history would be helpful. It started out on March 17th when Treasury Secretary Mnuchin announced a 90-day extension. And when you read the language in the extension, he says, just file your taxes and you'll automatically not get charged interest and penalties. So this certainly implied that it was going to be a filing and a payment extension. But when the IRS issued a notice the next day, they pulled it back a bit and said there was a payment extension only, but not a filing extension, which led to a huge uproar in the tax preparer community, as well as the taxpayer community. But what the IRS said was, and I'll mention this only to show the changes that occurred in case anyone hears the old information. It extended the payment deadline to July 15th. It included 2019 income taxes and 2020 estimated income taxes, in both cases that are due April 15th, 2020. And there's also imposed a dollar limit of in the aggregate amount of $1 million for individuals and $10 million for corporations. Well, as I said, there was a lot of lobbying going on behind the scenes, and the IRS, well, the first Treasury Secretary Mnuchin reversed course from the IRS. And on March 20th, there was a tweet talking about President Trump's direction, removing tax day. And so he made clear that it's going to be a filing and a payment extension. And then later that day, the IRS issued the current guidance, which is Notice 2020-18. They officially revoked and superseded the prior one issued a few days earlier. And then a couple days later, yesterday, the IRS issued 24 Q&As relating to that -18 notice. And so that's what we're going to cover in the next few minutes. There's the notice itself and the 24 Q&As. But I do want to mention the IRS is a dedicated coronavirus website, and I list that here for your convenience. These are links. When you get the slide presentation, you can just click on these links directly to get there. So what did the notice do? What is this extension, and who does it apply to, and who's eligible? And we'll cover that now in a moment. So first of all, it is a filing and a payment extension. It applies without any dollar limits, so that's very helpful. The goal of this extension was to increase liquidity in the marketplace, keep money in taxpayer hands, given what's going on with the coronavirus, the shutdowns, and the essentially freezing of the economy. So as a result of the extension deadline, there's no need to file extensions on forms 4868 or 7004. And so that's the big picture, is no dollar limits, full extension for everyone, and no extension forms need to be filed. So what are the taxpayers? Let's talk first about the types of taxpayers that are eligible, and then we'll go into some of the other areas about the notice and Q&As. First of all, it applies to persons as defined in 7701 of the code, which is very broad: individuals, trusts, estates, C corps, S corps, and partnerships. The IRS mentioned in the Q&A that taxpayers do not need to be sick, quarantined, or otherwise affected to receive the benefits of the notice. So everyone gets it, regardless of whether you're impacted directly medically or not. Tax-exempt organizations filing a 990T are covered, and this is different from what some people had expected. So if taxpayers that file a 990T are covered under the notice, they get the extension to July 15th, but tax exempts like hospitals and universities that only file Form 990 are not. Those forms are required to be filed by April 15th. So a bit of a difference there between those two forms. The IRS also published a list of forms. The 5500, I know, was a question we got in advance of this seminar, this webinar rather. 5500 is not extended. The IRS put a list in the Q&A of the forms that are extended. Basically, it's the 1040 series, the 1120 series, the 990T, and there's one or two others that were listed in the Q&A. So the timing and type of payments, it applies to all federal income tax payments, including self-employment, that are due April 15th, and that's the key, that due date. But the two taxes it applies to are 2019 income taxes and 2020 estimated income taxes. So what happens if a taxpayer files an extension? You come to July 15th, the taxpayer needs an extension. Normally, you file an extension and get 6 months. The IRS said here that's not the case. If you file an extension by July 15th, you only get an additional 3 months. So it brings you to what would have been your original due date in the absence of this special, 3-month dispensation. So if you do get an extension by July 15th, again, it's a filing extension, not a payment extension. So the payment's still due by July 15th, but if you do file that extension, you can have until October 15th to file the return. So the notice also applies to all returns that were originally due in 2019, but were extended. So if, for example, a taxpayer has a fiscal year ending in 2019, they file an extension that brings that they filed in the past, an extension that brought them to April 15th, 2020, that's covered under the notice. They get an additional 3 months. And this is a real change from what was expected, a favorable change. So no one's complaining about it, but it is a difference from what was expected. So I'm just highlighting some of the rules here that may take people by surprise or may be different from what they heard from their advisors. The notice does not postpone second quarter estimated income tax payments due in June. So you will have an unusual situation where your estimated income tax payment is due June 15th, but your regular, under the deferral of the notice, the payment's not due till July 15th. So there is that little, that payment quirk of the way the notice was written. There's two rules here. If a taxpayer already filed their income tax return and they owe tax, even though they filed already, they're not being punished. The payment is still not due until July 15th. And also, if the taxpayer had scheduled a payment, just a rule here, they put the burden on the taxpayer. If a payment was scheduled to take place in April, the taxpayer has to go in the system and cancel it and reschedule the payment, and they do receive the extra 3 months to make the payment. So the types of tax, as I mentioned, it applies to income tax only. It does not apply to payroll taxes, excise tax, and estate and gift taxes. Again, in a change from what was expected, the IRS did say that the extension will apply to Section 965 repatriation installment payments that are due April 15th and to the BEAT payments that are due on the same date. On the 965, this is a difference from what was expected because technically the 965 installment payment relates to a prior tax year, not the 2019 year. And it was the agreement then you paid in installments. The thought was that would not be covered. Well, in a helpful rule, the IRS did come out and say that the installment payments are deferred. So that is a beneficial rule that came out in the Q&As. IRS also came out with a bunch of miscellaneous rules here, which I group under this miscellaneous category, that taxpayers from a non-tax point of view, they can make contributions to their IRA until July 15th, so that is extended. They can still receive tax favored contributions up until July 15th. And also contributions to an HSA, same thing. Contributions can be made up until July 15th of 2020. There's a bunch of other IRS workplace-based retirement account rules in the Q&As. They're very detailed and specific. I didn't list them here, but they were mentioned in Q&As 18 to 20. So the extension, again, is an extension to file and to pay, but it doesn't help people who are entitled to a refund. So it doesn't apply there, and the notice does not apply to refunds. So as with always, it is always a case with refunds, the sooner taxpayers file, the sooner they get the refund. And refunds for the 2016 tax year must be filed by April 15th, 2020. The notice provides no relief on that. So if you want a refund, you do have to get that in by April 15th. And also, similarly, same rule for corporate taxpayers. You want a quick refund to overpayments. There's this Form 4466, which is what corporations use to get a refund of overpayments that come on an expedited basis. That has to be filed by April 15th. Just some planning points here when we talk about liquidity and bringing in cash at this time, which is, I know, crucial for many businesses. The overpayment has to be at least 10% of the expected liability and at least $500. We do want to highlight, this is where the planning point comes in, that the tax liability shown on the form, the 4466, is an estimate. And of course, you have to make a good faith estimate of what the liability will be. And we don't, no one's suggesting that taxpayers should be anything but completely truthful. But in terms of planning, there are ideas that taxpayers can take advantage of to reduce that expected liability. And so maybe there's we don't have time in this seminar this webinar to cover all of them, but we list some examples here, so some automatic method changes that don't require a 3115. We also point out that there are capital loss carrybacks that can be taken. You know, there's an election out of 163J for your 2019 adjusted taxable income, and also there's a series of foreign tax elections, the BEAT, foreign tax credits, FDII. There's planning can be done, which would help bring cash to businesses on an expedited basis. Also point out here, I know Barry and Jim are going to cover this later, but on the state and local side, indirect taxes, the same planning can be done as a way to bring in refunds sooner rather than later, and to increase liquidity for businesses that sorely need it. So we turn next to legislative enactments. I know this is probably what most people are interested in on the call. And so we'll start with the phase 1 legislation, which was enacted on March 6th. And this was an $8.3 billion aid package, providing a lot of aid for vaccines and CDC, health programs, research and development. But one of the key things we point out here is that they did provide $1 billion in loan subsidies to small businesses. And the goal of this relief was to enable the SBA to leverage this money to provide $7 billion of loans to small businesses and nonprofits, agricultural co-ops. And so that was the first relief package. We're not going to focus on that today. We're going to focus more on the details of phase 2 and 3, which was announced this morning, but not enacted yet. And I also want to point out on March 13th, that's when the president officially declared a national emergency under the Stafford Act. And as we know, the point of that declaration was to make funds available to the states, among a host of other things. And it also allowed the Treasury Secretary to extend the filing deadline. And the notice explicitly relies upon that designation in making that extension. So then a little bit later, on March 18th, the president signed the Families First Coronavirus Response Act. And this is the legislation that brought in the paid sick leave and family leave with the refundable tax credits. And we're going to talk about that in a bit of detail in a few minutes. But I want to point out that there's other aspects of this legislation. It provided $1 billion to the states for 13 additional weeks of unemployment insurance. It increased the Medicaid funding. There were grants to pay additional unemployment claims and to process those claims. Funds for food and nutrition assistance, free coronavirus testing, provided some liability protection for the masks and personal respiratory protection devices, and also some meal waiver program waivers where the USDA can waive some content requirements for certain food provided in group settings. So there was a raft of provisions in the legislation. Primarily what we tend to see questions on from employers and from employees who might be, think they might be laid off soon, or how do these paid sick leave and family leave provisions work? So let's talk about that, the sick leave and family leave provisions. The goal of these provisions is to allow employers to keep the workers on the payroll, and so they don't have to go on unemployment, and they don't have to choose between their paychecks and public health and combating the virus. It only applies to employers with less than 500 employees, and the reason for that, it was designed to put small and medium-sized businesses on par with large employers who are already believed to provide similar benefits. So that's why they capped it at the 500 employee limit. There's also an exemption there that employers with less than 50 employees can try and get exempt from the law if they can prove it would jeopardize the viability of their business. The IRS issued some guidance on March 20th explaining, they're not telling us yet what the rule would be, but they said they will announce simple and clear criteria for this exemption, and that guidance is expected this week. They promised that it would come out this week, so we should hear very soon how small employers can get out of this requirement if they need to, and they can prove it jeopardizes the viability of their business. So what does the law require? What is sort of the scope of the paid sick leave and the paid family leave? We'll start with the sick leave. It requires covered employers to provide up to 2 weeks of sick leave for employees who are unable to work or telework with one of these 6 conditions. And this is important. This is a lot of the questions we get around these 6 conditions. The first 3 relate to the individual themselves. So the employee is subject to a quarantine or isolation order. The employee has been advised by a healthcare provider to self-quarantine, or the employee has symptoms. So those are sort of employee specific. The next 2 are relating to care for others. So the first one, number 4 there, is caring for someone who is quarantined or subject to an isolation order, or caring for a child whose school has been closed, or the child care provider is unavailable. And again, it has to be due to the COVID-19 pandemic. And there's a catch-all number 6. Anything substantially similar is determined by the Secretary of Health and Human Services. So these are sort of the entryway into this paid sick leave provision, are these 6 provisions. What's sort of not covered is an employee who can't work or telework due to a workplace closure. Obviously, they're laid off, or the company's closed, like the retail closures. Where retail's closed, the sick leave provision would not come in because the workplace has been closed down altogether. Similarly, I recently had a question from an employer whose employee couldn't work because they were caring for a pregnant wife who couldn't really leave the house. That's unfortunate, but not something that's covered under the provisions here. On the paid family leave side, it's a little bit broader than the sick leave in that it covers up to 10 weeks of paid family leave. But there is a limit here that employers are only provided to give this to someone who's been employed for 30 days. And the requirements to get into the family leave provision are they can't work or telework because they're caring for a minor child if the school or place of care for the child has been closed, or the child care provider is unavailable due to public health emergency like COVID-19. We've had a couple questions about this. The legislation does define the word school as elementary or secondary school. So, elementary school, high school, does not include college. So a minor child, obviously suggesting under 18. So really, if you have a 19-year-old who's home from college, it wouldn't be covered under this provision here. The 2 rules here to protect the employees and to give them, really grant them full access to these rights. Employers are prohibited from requiring their employees to find a replacement to cover their time off, and also prohibits employers from discharging or discriminating employees who request leave under the Act or who file a complaint against the employer because they don't feel they were granted the full rights under the Act. There's also, I didn't mention in this slide, but there's a provision for unions, and employers can delegate the responsibility to a multi-employer organization like a union, and there are, as long as the union provides benefits, subject to that meet the floor of this law, the 2 and 10 weeks, it's appropriate for companies and permitted to delegate that responsibility to the union. So how much is required to be paid to the employees? The employer is required to pay sick leave at the employee's regular pay up to this cap of $510 a day for 2 weeks. So it's a $5,110 maximum liability per employee. That takes sick leave relative to their own health. That's the first 3 categories. If they're in the last 3 categories, we talked about caring for someone else, it's a reduced obligation. The employer is required to pay sick leave at 2/3 of the employee's regular pay, up to $200 a day, so for 10 days, so it's a $2,000 max, if it's in the last 3 categories. So that's the broader one is probably going to be the second category, caring for children out of school, right? That's the big one. Paid family leave, this is, again, 10 weeks. The employer has to cover not less than 2/3 of the employee's regular rate of pay, but there's a cap here. Well, the employer can always pay more, but if they want to pay just the amount that's reimbursed under the credit, which we'll talk about next, the payroll tax credit, the amount is capped at $200 a day, and employees are limited to 12 weeks any one calendar year. So really, it's going to be for 2020, it's going to be 2 weeks of sick pay, 10 weeks of family leave, and that's it. These provisions apply to full-time employees and part-time, although it's prorated for part-time employees based on the recent hours they've been working. And there also is an exception we've of great concern to hospitals and other healthcare providers where the employers can elect out of the paid sick leave requirement. The law does take effect. It takes effect 15 days after enactment. So when you do the math, that comes to April 2nd. So employers are not required to provide these benefits in advance of that date. And the law sunsets on December 31st, at the end of this year. So it is a very narrowly tailored provision designed to get us through the current pandemic, and then it sunsets and fades away. The refundable tax credits, is there a net cost to employees? The answer should be no. And as long as if the employer is paying up to the amount of the cap, the law is intended to be neutral for employers. So they pay the benefit and they recover the costs of the leave, either family or sick leave, through a refundable dollar-for-dollar payroll tax credit. I say up to the limits there again, that those caps were put on the prior slide. The employer will receive also 100% reimbursement again for the leave and certain health insurance costs if they continue them during the period of leave. But the amount is includable in income. And what they're trying to prevent here is a double benefit where the employer gets a deduction for the sick pay, but not a non-inclusion on the amount of the reimbursement. So there's no double benefit. So the reimbursement from the government is includable in income. So they're not in that deduction non-inclusion scenario. Paid leave is exempt when an employer does pay leave to employees, either sick leave or family leave. It's exempt from employment taxes, and the same rule applies if they continue the employee's health insurance. The credit is grossed up for the additional expense, and the self-employed individuals that receive an equivalent credit. I didn't include too much detail on that in these slides. There is some there's mechanics have been set forth in not fine detail, but in gross detail. Mechanics are set forth how individuals, self-employed individuals, can take advantage of the credit. We'll cover in a moment on the next slide, I believe. But there's no double dipping, so employers can't receive the credits under this legislation and also under the Family Medical Leave Program established under the Tax Cuts and Jobs Act in 2017, and that's in Section 45, Cap S of the code. So how do the payments work? There was some uncertainty about how exactly it would work and how soon taxpayers would receive reimbursement. Sorry, the concern was the lag between the date of payment to the employee and when they would receive the credits from the IRS. And so on March 20th, the IRS issued a news release, this 2020-57, where they said that reimbursements will be, quote, quick and easy. And they committed to processing these claims within 2 weeks. And so that's their sense of quick and easy. It is an immediate dollar-for-dollar credit against the payroll taxes. So what payroll taxes are included, and this is where it's very broad, which is helpful for employers. It includes withheld federal income taxes, the employee share of Social Security and Medicare, and the employer's share of Social Security and Medicare with respect to all employees. So just take an example where an employer has 10 employees and one goes out on sick leave. The credit that the employer receives will be immediate because they won't have to pay, and the full amount will be offset against their current payroll tax liability. So if it's a 10 employee employer, they're likely on a quarterly system, right? The larger the company, the more frequent the payroll tax deposits need to be made with the IRS. But so the employer can just pay in less at the next withholding, the next time, sort of impoundment date. And if there's sort of a rule of thumb, the way to think about this is, given that it covers federal income taxes as well as the 12.4, the 6.2, the 1.45, and then it doubles it for the employer's share. A good way to think about it is if 1 in 4 employees is out on leave, it will almost definitely be covered immediately, given that it covers withholding federal taxes for all employees. And that's probably 1 in 3 if you want to think about it that way. But so for many employers, unless if not a large portion of the employees go out on leave, it should be an immediate credit. They don't have to worry about the refundable portion, about applying to the IRS to get the money back. But if a taxpayer is in a situation where the amount of benefits they pay exceeds their payroll tax obligation, they can get a refund. So it's a refundable tax credit, means they can apply to the IRS on before year end and say the IRS has agreed to set up a streamlined claim form process where they say we'll process these requests within 2 weeks. So when the quarterly 941 is due, the employer would file for a refund saying I paid out, just make up a number, 10,000 in sick leave, and my payroll tax liability was only 8,000, so I'm owed 2,000, and the IRS hopefully will pay that amount within 2 weeks. So the money comes back. The lag is somewhat reduced. Here we talk about self-employed individuals. They claim the credit on their income tax return and they reduce their estimated tax payments. So there's more of a lag with the self-employed individuals than there is for employers. So that covers the family leave. We turn now to phase 3 legislation, which was passed this morning around 1 a.m. Recall that the Senate Republicans had released a draft bill, the CARES Act, the CARES bill, which will become the CARES Act. House Democrats released their own draft bill. So much is happening these days. It was either yesterday or the day before. I can't seem to remember now. Which was probably over 1,400 pages. It came out so fast, and legislation was likely to be enacted so fast that we didn't see a lot of accounting and law firm summaries of these things, including us. We didn't put something out knowing that it would be mooted by the legislation. But the Senate version, which was widely reported on, had the Republican priorities. The Democrats had their own priorities, which I mentioned here. And then the final deal reached this morning is expected to be, it was reported to be a $2 trillion aid package. Mitch McConnell said it's going to be called the CARES Act. When I listened to his speech in the Senate, it includes many provisions, but the direct checks to taxpayers, emergency loans, relief to hospitals and providers. What he said was the 4 pillars of his original Senate proposal are included. So we'll get the details. Will come out, I'm sure, later today and tomorrow. So many of those rollbacks of the TCJA provisions that people were expecting are probably going to be included. So that will be favorable for businesses. I know we've got a lot of requests for information on on many of those provisions, particularly the net operating loss, the 163J. People are wondering, are those going to be repealed? A lot of the fixes from the TCJA, legislative fixes and corrections that needed to be made, were in there. We'll see if they make that into the final deal that was reached. And then I mentioned here that the president is expected to sign the legislation this week, so it will be enacted quickly. And the hope is that the checks can start going out to taxpayers as soon as the end of the month. It may not be until mid-April, but it's something we'll, I'm sure, all hear about in the days and weeks ahead. So I turn now to some other business and tax issues that we thought are of interest to people during this time. And first is our credit facilities. And so we know businesses are cash crunched. There's a loss of revenue. A lot of businesses are shut down. Only non-essential, at least in New Jersey, non-essential businesses are closed. Essential businesses can stay open, but employees are encouraged to stay home. Shutdown orders are in place. So stay-in-place orders are in effect. So largely the shutdown of the U.S. and global economies. So liquidity is really the key to staying in business. And this is what we're hearing from our clients. And so borrowers need to prepare for future defaults, possible insolvency. There will be help now that this new legislation has been passed, and Frank's going to talk about some of the SBA loan provisions that have been enacted and are to be enacted, particularly loan forgiveness, which is something we're hoping will likely made it into the phase 3 legislation as well. So what do borrowers need to consider? I mean, drawing down existing lines of credit is obviously many borrowers are thinking about, is they should do it sooner rather than later. The cost of capital is relatively inexpensive, given that the Fed lowered the rate to between 0 and 0.25%. Fed funds rate's also not that low, but is lower. But borrowers need to make sure they're still in compliance with the credit facility covenants, financial ratios, that kind of thing. And so borrowers need to make sure that their financial statements are up to date. It's in many cases, it's up to the borrower to ensure compliance with the covenants before they make draws. In most loans, there's no requirement each time there's a draw to go back to the bank and provide financial statements, but the agreements do put the onus on the borrower. Borrowers also need to consider material adverse effect clauses. They need to be reviewed carefully with respect to the business operations, the assets of the business, and the financial condition of the borrower and its subsidiaries, because they need to avoid an event of default, which would close down the facility and prevent future borrowings. So these material adverse effect clauses, some of them are forward-looking, and if to the extent they're forward-looking, that's obviously a problem, because the tail off of business, right? The businesses should drop dramatically, and so a lot of these ratios are not going to look very positive on a forward-looking basis. To the extent they're backward-looking, it's obviously going to be better and less likely to cause an event of default. Credit agreements usually do not have an exclusion for general economic conditions, acts of God, terrorism, that sort of thing. Those are typically like force majeure clauses. And we also recommend that borrowers look at their EBITDA, definitions of EBITDA, to see what non-recurring items can be excluded. In particular, right, the non-recurring loss of revenue relating to the current pandemic. Finally, there's a problem we're seeing with borrowers getting audited financial statements. Auditors, can't really make on-site inspections at the present time, and so be likely to stay-at-home orders. So to the extent, getting a new line of credit is going to be slightly more difficult to the extent that audited financials are required, but things that borrowers are working through. On the M&A side, there's obviously been a decrease in M&A activity as business activity slows, and valuations, which are obviously dropping as they adjust to market conditions. We are seeing some opportunistic buyers out there. We're looking to get in at the right price, but even those buyers are facing real due diligence challenges, given the stay-in-place orders in the various states. Buyers in particular are looking on the diligence side. On-site inspections, again, are difficult. Having your diligence team assembled is also difficult, but they're taking a hard look at, debt forgiveness provisions of 108, NOLs, the limitations in 382, 163J. These are some of the things that buyers are taking a harder look at as they, realize that the companies they were looking at are going to be a lot cheaper these days. As a result of these diligence challenges, there's longer lead time for deals from signing to closing, and so sellers can expect that there's a longer lead time. And we'll cover in a moment whether people back out of these deals, but for those who are at the beginning of the cycle, we're looking at letters of intent. Usually they're non-binding, much to the seller's dismay and much to the buyer's delight rather. So if the parties are at the stage of a letter of intent was executed, usually they're written in a non-binding fashion. That's not always the case, but most often that is the case. And so renegotiations are likely to occur. So we've seen, clients focusing again on the provisions of the LOI, saying they need to renegotiate the deal. They want to get more information from the buyers, want to get more information from the seller, and sellers want to wrap things up as quickly as they can, is sort of what we're seeing, as you'd imagine. There's also renewed interest in asset deals versus stock deals to avoid, the buyers want to avoid the historic liabilities. And we're seeing parties really scrutinizing their material adverse change or material adverse effect clauses and the force majeure clauses, which are, the deal can't be closed due to impossibility. And so when you look at those clauses, they generally allow a party to terminate a deal without liability, but the clause has to be written broadly enough to cover the COVID-19 pandemic. There's no standard form force majeure clause, and so every deal you need to look at the specific clause and the language to see if it's narrowly written or broadly written. Sometimes they list some events like acts of God, terrorism. Is that list of events exclusive or non-exclusive? Is there a catch-all provision, where some party can argue it was intended to cover this? The events listed are not the exclusive list, or they're it's merely illustrative of the types of events that were intended to be covered under the clause. Who can invoke the clause? Can the buyer invoke it? The seller? Can both parties invoke it? In the current environment, usually it's the buyers trying to get out because they think valuations have dropped. But at the end of the day, it's a state law issue, legal determination that people will make in conjunction with their lawyers. And also, when looking at the state law, when it applies, you need to look at the choice of law provisions in the contract itself. If there's a signed contract, usually there's a provision addressing which state law governs if the buyer and the seller are in different states. We turn now to some employee assistance programs, and in particular, Section 139 is the first one we'll discuss. And this Section 139 allows individuals to exclude from income certain assistance payments they received, and they're usually from the employer. The employer provides some assistance. The benefit of this is it's tax-free to the employee. So the employer gets a deduction, and the employee has no income. That's that deduction non-inclusion scenario. Sort of, I wrote an article on this, which is on the web, and I think I mentioned this is the holy grail of tax planning, and it gives you the best of both worlds. The question is, does Section 139 apply to the current pandemic? A tad unclear, but most people think it does apply. And very, very briefly, the issue is that the president declared an emergency. 139 only applies to federally declared disasters as defined in that section of 165. In the current pandemic, the president issued an emergency order under the Stafford Act as opposed to a disaster declaration. So there are two different sections of the Stafford Act. But in the recent notices extending the filing due date, April 15th to July 15th, the IRS relied on that emergency declaration when a disaster was required. So they seem to equate the two. Given that, and also we understand that the IRS is considering this issue and may issue guidance on it. But assuming 139 applies, what kinds of things does it cover? It covers reasonable and necessary personal, family, living, or funeral expenses, but they have to be related to the qualified disaster, which in this case is the COVID-19 pandemic. So that's the first thing they cover, that 139 covers. Second is reasonable and necessary expenses, and this is less relevant here, for the repair or rehab of a personal residence, or repair or replacement of the contents. Right? This is intended to get out of a disaster scenario, a storm, a hurricane, etc. But the first one's going to be what people are looking for if a company pays reasonable and necessary, so not extravagant, but there is no cap. But it has to be reasonable and necessary personal, family, living, or funeral expenses incurred as a result of the disaster. So what's not covered? So first of all, we'll say what's not covered is items reimbursed through insurance. So if the employee gets reimbursed through insurance, let's say they have some family expense of $100. The employer pays them that money. It's tax-free to the employee, but then they recover it through insurance. So if they recover it through insurance, the employer's payment will be taxable. They can get two tax-free benefits there. What's not covered is income replacement benefits that the employer provides to an employee, such as sick pay, severance, lost wages, and also non-essential luxury or decorative items and services are not covered. We talk about this provision as employer to employee, but I want to stress it doesn't have to be. It really is any person to another. Gifts obviously are tax-free, but it excludes from income. Usually it comes up in the employment context. So what is covered? Medical and funeral expenses of the family as a result of COVID-19. We talked about that earlier, reasonable and necessary expenses. Child care workers, child care for workers whose normal source of child care is unavailable due to the pandemic, and also telecommuting costs, printer, office supplies, increased utility costs as a result of COVID-19. Some of these could also be business expenses. So 139 is one avenue, but it wouldn't be taxable to the extent also that it's just the employer's and you can borrow it, and you can borrow these office supplies and then return them when you can come back to work. On the documentation side, employers should consider a written program to prevent discrimination, to make sure the program is administered fairly, and to define the scope of it, how claims should be submitted, et cetera. But the interesting thing about this is it does not need to be an accountable plan. So taxpayers are not required to account to their employer how they spent the money, provided the amounts can reasonably be expected to be commensurate with the expenses incurred. So as long as it's a reasonable type of amount, it makes sense, the amount that the taxpayer doesn't need to account to the employer. So that's helpful, gives broader applicability to this provision. Employee assistance programs, we see the leave donation is a common thing. These have been around for a while. This is not new. Question is just applying this in the context of COVID-19. Neither is 139, by the way. But on the leave donation programs, the employer establishes a program. The way it works, where the employees can donate unused leave time either to other employees in need. So employee A gives their leave to a bank, and then the company gives that to employee B, or they donate, they give up their time, and the employer makes a cash donation to a charity. These types of programs, we mentioned for obvious reasons, enhance employee morale and camaraderie, reduce turnover. It's nice, employees feel like they're part of a team. They feel connected to a large organization. On the tax side, the implications to the donor and donee really depend on the structure of the arrangement. We're not here to, I couldn't have time to give you full details of this program here. I want to mention it's out there, it's available. These are established programs. You don't need to reinvent the wheel if you set one of these up. But the donated leave generally is taxable to the employee who receives the leave. On the charitable contribution side, the donor may receive a charitable contribution, someone who gives up their leave, depending on the structure of the arrangement. There's some details, but the IRS has approved them generally in major disasters, medical emergencies. So these are something that's out there. We just want to highlight that to you. Similarly, employer loans, if employers need to make loans to their employees, the general rule is that bona fide loans are not taxable to employees, to shareholders, really to anyone, upon the receipt of funds. That's the general rule with a debt instrument. When you receive money, it's not taxable because there's an obligation to repay the loan at a later point in time. In the employment context, you really need to consider Section 7872 governs below market loans. So if the loan has a below market rate of interest, that section may say there's a compensatory element to the arrangement. So for instance, if interest rates normally are 5% and the employer gives a 1% loan, well, they've transferred value of 4%, right, to the employee, and that can be considered compensation. That's sort of what the provision is designed to do. There is an exception, though, from this section for aggregate loans of employees to 10,000 or less. So this is helpful if a company they can give zero interest loans for 10,000 or less to employees, and there won't be any compensatory element to it under 7872. And I also give you an example here. I looked up the rate. The minimum interest rate for a 5-year term loan is just under 1%, for example. And so that rate changes based on the term of the loan. I think it's between 3 and 9 years. The rate currently is 1%. So if an employer gives a 1% loan to an employee, there's no compensatory element to it. It's a bona fide loan as long as the employee is going to repay it. If the employer wants to forgive the loan at a later point in time, that's when there might be taxation. But absent loan forgiveness, these are the sort of terms under which employers can give loans to their employees. Employer provided meals. This is not really a big issue, but we have seen some questions on it. Generally speaking, meals provided on the employer's premises are fully or partially excluded from the employee's income. Similarly, employer-operated facilities are tax-free to the employee, provided the employee's on the premises eating at the cafeteria, for example. But now that employees are working from home, if an employer starts paying for their meals, that's likely going to be taxable to the employees. And so the amount should be included in their W-2 because it's not likely a de minimis fringe benefit. It's not a workplace sort of holiday party. It's not, giving out the turkeys on Thanksgiving kind of scenario where you typically have a de minimis fringe benefit. But if the employer wants to do that, they can always gross up the employee for the cost of the meals. So provide the meals, it's fully taxable to the employee, and the employer can just gross them up for the tax payment that they would have to make. Commuting and parking. Similarly, generally speaking, if an employer pays these for an employee, it's taxable. And the exception is a qualified transportation fringe benefit. Those are these transit passes or parking benefits that many employees take advantage of. And so in a lot of cases, workers have already purchased these parking or transit passes that may go unused because they're not commuting to work any longer. So I think we put out an advisory on this too, that employers should just consider advising the employees. They may want to suspend the payments to the program for the months of April or May. It may be too late for April to do that. Maybe they can get a refund, maybe not, depending on the plan. But if they don't expect to be commuting into May, again, it's something employers can advise employees. Not a huge benefit to employees, but it's something, and it shows the employer cares when they're thinking about ways to save the employees money during this time. It seems silly to buy monthly passes, train passes to commute to New York, for example, where if there's a stay-at-home order in effect. From the employer's perspective, generally speaking, under the Tax Cuts and Jobs Act, that's Section 274L1, disallows a deduction if the employer pays the employee's commuting expenses, except when it's necessary for the safety of the employee. And it's not clear whether this applies to the current pandemic, but something to think about. We can have a discussion with if anyone's interested or has this concern, we can discuss it and figure out whether the exception is broad enough to cover whether it's for the safety of the employee given the current situation, and how the expenditure the employer wants to pay is necessary for the safety. On the health insurance side, the IRS issued guidance on March 11th, notice 2020-15. The issue here was just that the employers wanted to provide free COVID-19 testing, but a lot of employees signed up for these high deductible health plans so they can make these HSA contributions. Well, the issue was that if the employer is giving a free treatment, or the health insurance is providing free testing or treatment for COVID-19 without imposing a deductible, it jeopardizes the status of the plan as a qualified high deductible health plan. So the IRS issued a favorable notice saying that health plans that provide free testing without regard to deductibles are not jeopardizing their status, meaning that the employees can still make tax-favored contributions to health savings accounts. So that's a helpful piece of guidance that came out. This was one of the first notices issues relating to the COVID-19 pandemic. And then the last topic I'm going to talk about before turning it over to my state and local colleagues is severance. And unfortunately, many employers are considering layoffs as a result of the economic shutdown. So we just wanted to highlight some of the issues that they should consider. We're not suggesting they need to be done or whether to make these payments, just highlighting some of the options and things employers should think about if they're going to do this. One is, whether they make severance payments to the employees. That's the obvious one. Do they make a cash payment for in severance? Do they provide continued health benefits? Obviously, under COBRA, they have to. They can always exceed that. Certain employers have to, I should say, not every employer. Stopping contributions to programs like flexible spending accounts and qualified fringe benefits. Obviously, they need to be shut down, as well as supplemental employment benefits and liability releases. And there are time periods that employers must wait from when they provide that release to the employee in order for them to take effect. We also want to point out that our state and federal WARN acts, these worker adjustment and retraining notification acts, and these acts generally require, if there's a plant closing or a mass layoff, that employers need to give a notice requirement to employees. At the federal level, I believe it's 60 days, but there's also state statutes. And New Jersey, for example, recently made changes to the WARN Act in January of this year, and sort of a groundbreaking changes. First, they extended the notice period to 90 days. And they said it applies if someone lays off 50 or more employees. So I think if they have to have 100 or more employees, it applies to them. And if they lay off 50 or more in the state, then they trigger the New Jersey WARN Act. And the New Jersey WARN Act requires, among other things, severance payment. And so I think it's a week for every year they've been there. And so these WARN Acts now are at a minimum require notification. And the other, New Jersey, I believe, was the first in the country to require severance. Other states may have followed suit. So we mentioned to employers, if you are thinking about this, consult your lawyer to see what your WARN Act obligations may be if you're going to have a large layoff. And that what's considered large varies by state. So it's really state specific. Also, employers need to consider tax withholding and reporting aspects of these severance benefits. Just need to make sure that whatever they provide, they properly withhold and report to the employees. So with that, I'm going to turn it over to Jim Bartek, who's going to start talking about the state response, which has been massive, and I know has been keeping him and the state team up day and night, keeping track of the developments. So over to you, Jim.
Just to cut in for a second here, for those of you that have your hand up and that are asking questions, if you missed the beginning announcements, we're going to be answering all questions at the end of the presentation, and we understand we're not going to be able to get through all of them, so we will be sending out an email with updates. Thank you.
Okay, thank you, Dan and Allison. I hope everyone's staying safe and well, of course, in these times. We're actually taking these calls from home. Of course, this webinar, we're usually in a room. I'm Jim Bartek. I'm a state and local tax partner at Withum, and I'm here with Barry Horowitz, a state and local tax partner at Withum, and also the SALT team lead. And what we're going to talk about here is how state governments and tax departments are responding to COVID-19. Now, if you've worked with state and local taxes before, you'll know that they've always been complex and cause a lot of anxiety, since every state has different rules and deadlines. Again, I like to explain it as 50 states, 50 different sets of rules. So although business operations have been disrupted, we still have to think about compliance issues and state taxes. And although most states' budgets are certainly going to be strapped, many states are making some temporary changes to help alleviate the immediate cash crunch for the taxpayers. They do realize companies are cash strapped and need to keep running. Therefore, companies do need to keep close attention or pay close attention to how state and local governments are quickly changing their filing deadlines and what else they're putting out there resulting from this emergency. And we can't cover all updates, but during this segment, Barry will discuss on the income tax side how states are delaying filings and or payments. But for some businesses, sales tax could be one of the largest taxes they pay as well. So therefore, we'll cover that as well. More states have been addressing income tax delays to date. They'll also go through some delays in the sales tax filing due dates and payment changes. So for sales tax purposes, of course, the economic nexus rules resulting from Wayfair case in 2018 have made it difficult enough to comply. Now remote sellers have to pay close attention to these changes from many states as well as localities which are coming in. So there's over 10,000 taxing jurisdictions around the country, so you can imagine how busy we've been trying to keep up to date with this. A delay in filing or payment may help companies with their cash flow, or if they have trouble collecting from customers, because of course your customers may be in a cash flow crunch as well. However, keep in mind, it does not mean that you get to keep the money. Sales tax is an agency tax, so and companies are agents of the government. This money does belong to the government, and we'll cover that a little bit later. So what you're seeing on the website right now is the Withum COVID-19 Resource Center. And on that Resource Center, we actually have a link on the bottom to get to that Resource Center. But on this is a map that's on there which shows which states have updates, and this particular map is the income tax side. So keep in mind, each state has its own laws and regulations, which complicates matters. So again, in order to provide guidance to our clients, as well as Withum partners and tax teams, our state local tax team created this map and placed it on this Resource Center for everyone to take a look at. And how you use this is we can't do it now because it's not a live website, but if you click on one of the black dots, you would actually be able to get to the state tax update for that particular jurisdiction. And hopefully you remember your state maps from grade school. But there's a link on the bottom for the Resource Center. Next page. Okay, there's also other guidance on the site, such as sales tax updates, and this is updated multiple times a day. There will also be something on there for employment taxes, and not only for state and local taxes, but other issues as well. And as I'd mentioned, updates will be coming in frequently, and we posted throughout the day. Next slide. Okay. Now the state taxes, all state taxes are affected by COVID-19. So companies should note that it's not just going to be income taxes or sales taxes. It could also be potentially payroll, employment tax issues. And Barry's going to touch on some of that as well. And then what we're also going to talk about at the end is we're going to discuss issues such as how to handle audits, notices, as well as potential opportunities companies may want to look at now while they are cash strapped. And again, as I'd mentioned, you have corporate income taxes, gross receipts type taxes, real and personal property taxes, and other transfer taxes or excise taxes. Okay, next page. Now I'll turn it over to Barry to discuss some of the state-specific issues.
And good afternoon, everyone. Again, I hope everyone is safe and in a good environment. Jim and I, as we said, we're spread all over the state of New Jersey. Jim and I are working 60 miles apart now, but we speak five hours a day. So we're going to go through some major states, what's going on with their filing and their delay of tax payments. And it's all over the map. But we have the map in the United States, and it's been all over the place. California was one of the first states to come out with a delay in the tax filings, and they actually updated theirs and changed it at real time. We had a caveat in the first page when we were dealing with the state and local taxes, basically stating that it's changing by the minute. Every time the federal government makes a tax change, the states will look at it, and obviously all of us are praying that this crisis ends faster than later. But obviously, if this drags on, we could see changes in due dates again and again until everybody's up. Most states are closed. Most states' taxing authorities are shut down like we are. They're working from home. And if you realize when you work with the government, their computer systems are 10 years behind ours, except for a couple of states. So what we are trying to do is be real time, give advice to our clients, help out, and continue to do compliance and whatever else. So just dealing with the state of California right now, July 15th, 2020 is the personal due date. July 15th, 2020 is basically the date, and that's basically the same dates now as that the IRS has set up after Secretary Mnuchin made the change with the president under the president's advice. So again, same thing, July 15, 2020 for revised due date for sales tax for California. Next. Okay, District of Columbia, they are July 20th, 2020 due date there. Same thing with their C corporations. Most states, and we've been in contact with many state officials in various jurisdictions, they will be waiving penalties. Hopefully states may waive interest. We don't know. Interest is usually not waivable, but certainly penalties for late payments and certainly a deferral of payments is out there. Every state and many of the large localities all have their own budgetary constraints. They have to have balanced budgets. They have no revenue coming in right now. So they are going to try to get as much revenue as they can, as fast as they can. However, all these jurisdictions will be piggybacking off the federal. Most of them will be following what the IRS is doing. And again, revised due dates the 20th of the month on that. And again, abatement of interest and waive penalties for failure to pay sales and use tax. Again, a sales and use tax, as Jim mentioned before, is very important to realize. It's a trust tax you have collected on behalf of a government agency. It is not your money. It is the government's money, and you're just the agent for them. And we're going to get into a little bit later and discuss again the trust tax problems that we foresee in this crisis. Next. Florida. Florida obviously has no individual income tax, and right now they're staying with their May 1st, 2020 original due date for C corporations. However, if the C corporation returns aren't prepared for the federal, I don't know how you're going to file a Florida tax return. So again, each state has their own COVID-19 website and contact, and we are constantly monitoring it. Same thing with sales tax, the 20th of the month. And I always have discussed over the years, Florida is one of the states that lives and dies on sales tax. And there's Disney World and the cruise ships. Well, nothing is moving now. Tourism is ground to a halt now. So Florida is one of those states where if rent is out there that has to be remitted, they're going to be looking for those sales tax payments. But again, we have deferrals all over the place. And again, every state is trying to figure out how to get some money into their coffers to make these to make payments back to their citizens of those states. Next, Jim. Next, Dan. Thank you.
Now, Barry, just wanted to jump in here. Hot off the press is we received some notice from Florida that they have not extended the due date, but they're willing to waive sales tax penalties if companies are unable to meet the sales tax obligation. So again, to Barry's point, they're not waiving the sales tax deadline. They need that money.
Yeah. Illinois, you may not be dealing a lot with Illinois, but we put Illinois here as a model of how states are trying to come up with creative ways to get money in the door. and we may see many states coming with the exact same scenario. So again, same thing, July 15th following the federal, May 15th, still staying with the C corporation dates, but I'm assuming that's going to get moved back on that. And again, we have many clients that are on this call that have multi-state filings in various jurisdictions, and Illinois is one of the big states in the United States. So many of our clients file in Illinois. Again, they'll waive interest and penalties on here. So again, that's a good area. Some states will not waive interest, but we'll deal with that. Sales tax due the 20th of the month. A lot of states are always doing the 20th of the month. But again, on the payment guidance, what Illinois is trying to do is allow eateries and drinking establishments or whatever else to stretch out their payments, make it in four installments over a certain period of time. So again, we are going to see a lot of jurisdictions coming up with some creative methodology to ease the burden on the taxpayers, but also to get revenue in there. Short-term relief of payments or whatever else. And again, waiving penalties and interest. Again, states have they don't have as much staff as we are in a lot of times, and it's going to be a battle for them to get their computer systems up and running, to get everything modified, and to waive these penalties. So we have to work with them. We're all Americans here, and states, governments. We all live in different states, and they run our lives or whatever else. So again, we have to be considerate of their side also. Next, Maryland, staying with July 15th due dates. We're seeing personal income tax and C corporations, and again, no penalties or late payments will be imposed. Sales tax is due June 1st, and again, Controller Franchot actually issued that if you made the tax payment last week, you can actually get a refund back now. So this is one of the states that actually is going the opposite way. It says, hey, if you paid your sales tax in now, we'll give it back to you. You may have to pay it back again, but again, it's just, they're looking for short-term relief. I don't know how Maryland is. We tried to get through to them yesterday and nobody picked the phone up. So I don't know how good this might be, but again, these are what states are trying to do to alleviate the tax burden on so many different businesses. Next. Massachusetts. Massachusetts still has stayed with the April 15, 2020 due date. They piggyback the federal tax returns in picking up AGI. This will be extended. Massachusetts is, again, one of these states where either the legislature is not in session or the governor has not yet issued an executive order, if he's allowed to do that, because again, a lot of states have their own constitutional rules like the US government does. So again, we're looking for guidance and we're waiting for Massachusetts to come down. Revised due dates again for sales tax. They're suspending it out. They're moving it out to June 20th of 2020. Again, certain businesses do not qualify for this exemption. But again, we got to make sure that compliance continues to make sure we fit under all the guidelines. Next. New Jersey. So the state of New Jersey, very interesting. It says expected to mirror federal law. The state and local, the New Jersey legislature has passed a law extending the due dates to July 15th or June 30th, and we're still waiting for Governor Murphy to sign that bill. So it's on his desk, it's in there, but again, as of today, the law is that. We've been in contact with one of the top officials in New Jersey. He expects it to get signed. We expect New Jersey to have information coming out in the next few days regarding extensions. We expect everything to be extended to July 15th. And on the other side, Jim, you might want to jump in and just talk about the Jersey budget carriage constraints of June 30th.
Yeah, one of the things that they mentioned, of course, was in the bill is that it could not extend, payment could not extend past June 30th. And the reason is because the budget year ends on June 30th. So obviously they want their money before June 30th. I think that's probably one of the holdups right here, Barry, and we'll
Yes.
hopefully hear some guidance soon.
Yeah, and again, both Jim and I, have our ears to the, an open window to the officials in New Jersey, and we can certainly, hopefully, get information quicker than a lot of people. But we're monitoring this, like we said, on a real-time basis, and as soon as something comes out with New Jersey, it will be posted to our website, and certainly you could talk to one of our state and local specialists on this thing. Same thing with the sales tax, the revision, the 20th of the month. Again, not any guidance yet. We expect Jersey to be catching up this week on guidance. Next. State of New York. State of New York, the only thing that we've seen so far expected to mirror federal is something that came out in the Times Union newspaper, which is an Albany-based newspaper, saying the state has said that they're going to extend the due date to July 15th. Governor Cuomo of New York has been at the forefront. I think right now he's dealing with the health issues first. He wants to get that under control, but I have no doubt that New York State will come through and extend everything out to July 15th. We're just, again, waiting for it. We've been in contact with deputy commissioners up in Albany, just waiting for the state to come through again and give their guidance there. You know, I've dealt with the head of audit for New York State and the head of collections, Deputy Commissioner R.J. O'Leary. State's looking for money, but they know that people don't have money now. If there are agreements out there that we want to sign off on or whatever else, you know, we start making payments that you can make. The state will work with us. They'll waive penalties. They'll come up. We'll work out installment agreements with them. The states will work with us because everybody's in the same exact boat as we said before. This is a nationwide, it's a worldwide situation, and so every state will be working with us. Again, it might be a little slower in getting things abated. People have to give patience, and again, we have the right people to work with. Sales tax, again, revised due dates 20 of the original month. It's still original due dates, but New York State is going to be delaying it per an executive order. But one thing that you have not delayed is prompt tax payments. Prompt tax payments are usually done by big retailers and the big high-end, the big sales tax collectors, hotel chains. They have to remit basically on a monthly basis. Okay, that again is a trust tax, and the state wants that money. After this week, there may not be any prompt tax payments anyway because most of the businesses are shut down in New York, as you've seen. New York City is basically a ghost town. I'm based in Withum's New York City office, and we are basically shut down out of that office right now. Nobody's working. Everybody's working remotely there. Next. Okay. New York City, just wanted to let you know there are no extended due dates. New York City, again, is a piggyback to the federal and New York State tax returns. So again, if you can't prepare a federal return, I don't know how you can do a New York City return. The commissioner in New York City has the authority to waive penalties. They've set up a lockbox up in Binghamton, New York, to send waiver penalty notices. And in my dealings with the city has basically said that they're going to waive just about everything going down the road. So again, they don't have enough manpower, but again, they will be working with us and getting things out. But again, if letters have to go out, they have to be filed to make sure we've covered ourselves in that we've made the request for an abatement of penalty. Next. Pennsylvania, same thing. July 15th for individuals. The C corporations still at the original due date. We expect that to be extended also. And again, PA is waiving penalties and interest on the 2019 returns. And again, and estimated payments they're dealing with, and we're going to have to deal with the estimated payments also as they come up. And I expect to see more and more guidance coming up from all the jurisdictions about this first quarter, second quarter payments that are due April 15th or June 15th. Again, revised due date, the 20th of the month for sales tax. And again, the same thing, waiving penalties. Next. Okay. So with that, we've tried to give a kind of a overall view of what the major states are, where a lot of Withum's business is based out of. There may be other states that are there. The COVID-19 website that we've set up with the clicking on the maps gives full detail of what's out there, what's there. All the Withum professionals, and especially the state and local team, will be there to help answer your questions as we get that. We're all in the same boat here, and things are just coming in that we can't even keep up with. So Jim, why don't we talk you and back a little bit about what we see going on now with the payroll and employment tax area?
Yeah, sure. So again, we're going to go through this quick just because we do have a time limit, of course, and we definitely want to get to Frank. But basically, of course, we have a lot of companies including us, that are working from home. So we're getting a lot of questions on, well, where is the tax due? Where do you collect the income tax, which state? So you have people usually work in New York, working in New Jersey. And again, New York has this convenience of employer rule, which basically says, in high level, wages or considered New York sourced unless the work is performed for the in that location for the necessity of the employer. Now here you have voluntary or encouraged, which is what we're at right now in the public health emergency, versus mandatory work from home. So again, there's some we're waiting for some guidance from the states on this. I don't expect to hear it soon, unfortunately. And of course, other states' rules may differ as well.
Yeah, and Jim, I would just say that on this area, nobody should be changing any type of payroll withholding or anything else right now until we find out. My gut feeling, again, this is government mandated. Governor Murphy, Governor Cuomo said, work at home, don't come in. You can't get into the city. So you know what? This is a government mandated shutdown, basically, of our offices. So again, we don't want anybody jumping. One of the biggest areas that I've seen problems with, and it's just to be exacerbated here, and hopefully it doesn't come to this, but if anybody has to file for unemployment insurance, they must check with the employer first before they file. Because we've seen many times where if I'm sitting in New Jersey, and even though I'm working for a New York employer and I based out in New York, they will file for unemployment in New Jersey where the employer is not registered or telecommuting in other states. That person will not get unemployment benefits, and then the question will come up. They will ask the company, how come they haven't paid in? So it is super important if any people are terminated and you're dealing with multi-state, that the HR departments get involved, and nobody files anything until the pecking order is looked at on how to file unemployment insurance. I do not want to see any clients get into a problem here by an employee filing in an incorrect state if they're telecommuting or forced to work somewhere when they can't get back. And again, I just want to reiterate that it's not where the person lives, it's basically where the person is based out of. We also recommending to monitor any guidance from the states. And I think after this thing is over, it's going to be a superb time for companies to review their employment and withholding policies and what they're doing, because, you know, I think what we're all learning is, hey, we can telecommute, we can work together, you know, as a firm, and we're not manufacturing stuff, but service organization. A lot of us can work together based upon internet, phones, you know, anything that's available as Teams or whatever else. So again, it's something we've learned here. Next.
Okay, so helping clients save cash is what we've been trying to do in the last couple of weeks. We always try to do that, but of course that includes getting some favorable settlements for audits. So let's talk a little bit about audits. And again, we're going to go through this super quick just because we have time limitations. But auditors like us, have been asked to work as at home. So many will adapt and they'll continue the audit. I do suggest you keep open communications with the auditors. We have. You can conduct virtual meetings, calls, share screens. Bottom line, keep in touch with the auditor. This could be a good opportunity to expedite the review as well. Believe it or not, I've sensed a bit of empathy from the auditors, not just for us, but for them, but maybe because we're in the same boat. But you could have scenarios where on a sales tax audit, for example, sales or expense invoices or exempt certificates may be tough to get, especially if they're hard copies. So you really have to be creative and look for alternative methods to condense the scope. And also you want to evaluate whether to keep waivers open. That could benefit you to extend it, obviously, if you're cash strapped, but also if you have refund opportunities, it could also benefit you to extend the waiver. And again, since states are looking for money now, we've had some good results negotiating settlements because they're going to be struggling for money. So don't forget that once the audit is complete, review your process and help eliminate errors in the future. And of course, we also in here we mentioned you may receive notices. Respond to them immediately. Don't assume that you cannot respond to those. You want to protect your rights. We mentioned responsible persons here before. Again, sales and use taxes or payroll taxes or trust taxes. You want to make sure you are remitting them to the state, or make sure you're not using that money for other means. And then one other thing we're monitoring is potential nexus issues due to remote employees between sales tax and income tax. Again, now you may have a presence in another jurisdiction.
And Jim, we hate to mention the word bankruptcy, but bankruptcy will occur. There will be companies that will have to file for bankruptcy, unfortunately. in this crisis. And again, we have to make sure that you're cognizant of all kinds of proof of claims or whatever else that are out there. And again, as Jim and I keep on saying, responsible persons, if there is sales tax and payroll taxes not remitted that are not covered by this, it will continue to inure to the responsible officer, even in bankruptcy. So they never go away. And that's something that could haunt somebody for, their business life, the rest of their life. So again, we're trying to cover different areas here and make sure everybody's just aware. We're going to have to deal with it. But again, we just want to make sure everybody's cognizant of what's going on.
Next.
Yeah.
Thanks. Go ahead, Barry.
Jim, I just want to alert you about time limitations to give Frank enough time to speak.
Yeah, we got one more minute. We're going to do it. So again, we're talking about potential opportunities out there. There might be refund positions that can be taken on returns. We may want to look for it, review quarterly estimates. There may be 0 quarterly estimates. Who knows what's going on with everybody's business or whatever else. Indirect taxes, there's going to be extension of times to file sales and use tax. There may be refund opportunities where you may have over collected tax and paid it in. There might be opportunities there. Real property and personal property may certainly go down in value, so we can maybe look at revalue that. And there's voluntary disclosure programs, amnesty, and installment agreements that we have out there that we can help alleviate some of the pain if payments have to be made. And again, Jim and I will just quickly, we talked about doing this thing, but we're going to constantly monitor any state and local incentive programs, R&D credits, employment credits that may be available to taxpayers on tax returns, and certainly make sure that it is taken care of when we file a tax return.
Yeah, I do expect certain states are going to be aggressive in attempting to retain or attract new business. Again, please email or call me or Barry with questions. We're here to help. Now I'll turn it over to Frank.
Great, thank you. Thank you everybody for attending. I'm Frank Boudelet. I'm an audit partner in the financial service group, and I'm going to talk a little bit about the what's available through any loan assistance out there. And there's a lot of confusion right now on what programs are available from the SBA. And also I'm getting a lot of calls from clients and what they should do. So, what Dan said earlier about borrowing monies that you have lines and pull down. I just spoke to a couple bankers that we deal with, asking them what they thought would be a good thing for our clients. And they're thinking they will extend some of the loan terms out 90 to 120 days. So I think the first thing that you want to think about is if you have a loan outstanding currently, any debt, talk to the banks, talk to the lenders and see if they'll extend it 30 days, 90 days to 120 days. That might be your best bet. And as an alternative, if you have some losses, then you have these available programs with the SBA. So I'll talk about these 2 programs. And as I go through them, there's some changes that are occurring. There's a lot of information out there. I will direct you again, we keep saying, to our COVID-19 Resource Center. We have a lot of information on the SBA rules and how to go about applying for these loans. I've been researching it, and I've looked at many large law firms, largest accounting firms, with the information they're putting out, and there's a lot of contradiction because I think the issue is that there's not anything that's definitive, and there's a lot of interpretation to the rules. So with that, so the SBA has a couple different programs. Right now, what they have is the Economic Injury Disaster Loan Program, the EIDL. That is currently in place. That occurs when a federal disaster for a certain region is declared. That kicks in. On Friday, only 43 states had declared a state of emergency. Well, now I think all 50 by today have. So that you go online to the website for the SBA. Now that money comes directly from the SBA, whereas the second program, which is the standard 7A loan program, which that's the one everybody's talking or hearing about with his amendments on the CARES bill that was passed last night, that has these other provisions in there. That program has been around as well, and that offers another avenue to go to get some funds. And then they have the Express Loan Program. That program was a $350,000 loan. They've increased that to $1 million, and there's that hasn't changed. So the parameters on that loan haven't changed with what's going on. But so that's available for you. So the next slide, please. So on the disaster loan, this is now the first line here is SBA determines business cannot obtain credit elsewhere. That has been waived. Recently, that typically the old this loan that was available had certain criteria where you had to be credit worthy. You'd be able to get loans elsewhere. They've waived that stipulation. It does allow for a $2 million max. The SBA can waive that maximum amount if you are a large employer, employing a lot of people. Even though you're a small business, you're at the top end of the criteria. And the small business defined by the SBA, they have criteria based on your industry code. Some are based on sales volume, and some are based on number of employees. So that information, and I think on our website, we're going to put that information out there. So a link so you can just go right to it and find out what industry you're in and if you qualify as a small business. Under this program, the interest rates will be 3.75% for businesses and 2.75% for nonprofits. So yes, non-for-profits that have had a loss can apply for this loan. The term will be up to 30 years. And during the period, again, we waived the elsewhere, so sorry I missed that piece on there. I'm pulling on the slide. And the loans cannot refinance any long-term debt. So I've been getting a lot of questions. I have already a mortgage or on the property. Can I refinance one of these facilities? And on this one, the answer is no. Now, again, this one you're going through the SBA. Next slide, please. It's a 3-step process. So one, you'll apply for the loan. You can apply online. Now, we've been hearing, and I've seen it and witnessed it, that the SBA's website is crashing. Everybody's on the website. So what we did is we should be having up any minute now. We're loading all the forms that you would need to upload into the SBA program. I'm not exactly sure if they can be uploaded or you'll have to just go online and fill them out there. But the point here is that you have the information, all the loans and all documents that you're going to need to start filling it out. Because once you can finally get onto the SBA website to apply for this loan, you want to make it a smooth transition into entering all the information. Now, some of the things that they're going to be looking for is a business loan application. They're going to have the IRS 4506T, which is asking for tax information, personal financial statements, copies of recent tax returns, monthly revenues. Now, on the monthly revenues, they want you to go back 3 years from the date of the incident. So you'll go back 3 years and give a history. What they're doing on this loan is they're looking to see how much revenue you had previous and then how much you've been impaired by this disaster. They also want a schedule of the liabilities. The liabilities on their form includes notes, mortgages, and accounts payable. I had somebody had called me, said, what about deferred revenue? I do not think that deferred revenue will be considered a liability for this type of a loan. But those are things that we're still researching and trying to get that answer to those questions. Loans over $25,000 will require collateral if it's available. So if you're only looking for $25,000 or less, you will not need collateral for that. And I believe they're also waiving the personal guarantee. Next slide. So what happens is once you go online and you upload the information, you will have it'll be reviewed by somebody at the SBA. So the loan officer will contact you. They'll go through all the forms you submitted and determine how much your estimated loss was. They'll come up with the determination of that, and that'll take about 2 to 3 weeks. So we have a couple clients now that they're in the second week, and they've been seeing some movement where they're looking at credit checks, because they will check your credit score to make sure you have the ability to pay this loan back. Next slide. And then the last step is where once they've finalized, they'll send a loan closing document for signature. Within 5 days of you sending that back to the SBA, you should be getting the first round of funds, up to $25,000. That caseworker will then work with you to go through how much your future disbursements will be and when they will be to get you through this crisis. So that 3-step process is there, and that's for the the injury disaster loan program. Next slide. I apologize if I'm going too fast, but I want to get to everybody in case you're jumping off the call. The next program, and that's where a lot of the information online has been floating around, is how do I get this loan? So this is open to any business that has less than no more than 500 employees, private nonprofits and public not-for-profit entities, and also small business concerns. And what that is, the reason that was done is up to 500 employees, because you could have an industry where 100 employees is considered a small business, 101 is a large business. So this loan program was extended to now have up to 500 employees. So that industry could potentially go up to 500 employees to qualify for this loan. And the industry had, it's based on your industry codes. It covers, now the covered period for this loan is March 1st to December 30th. So anytime you see covered period for determining how much loan you'll get, it's that period that we're talking about. The maximum loan will be 4 times the average monthly payroll, mortgage payments, rent payments, and payments of any other debt obligations for the 1-year period prior. So it's going to be very important to have all your information together on how much you were spending for all of these type of obligations, and it maxes out at $10 million. So that's what's available for you. Next slide. Okay, so the normal fees, which typically the SBA would get 1 to 2%, and now this program, the banks are loaning the money, not the SBA. So the banks are waiving that fee as well. They're encouraged by the SBA to waive any loan fees. They'll be deferring the payments for up to 1 year. The loan forgiveness, this is where everybody's talking about. I believe that the bill that was passed last night will keep most of the loan forgiveness piece in place. And this is where I'm getting a lot of calls on, what is this loan forgiveness? How does it work? So basically, it's going to cover your payroll costs incurred during the cover period. Now, they changed the cover period for loan forgiveness to a shorter period, March 1st to June 30th. So any payroll that you've paid during that period, plus amounts paid for debt obligations, which I believe is going to be interest on any loans that you have, can get added up, and that will be the maximum amount that you can have as a loan forgiveness. That loan will be reduced if you are reducing the number of covered employees. Next slide. So it's going to be, so it gets reduced. So for instance, if you have 10 employees prior to the disaster, and now during the covered period, March 1st to December 31st of 2020, you only have 8 employees because you laid 2 off. You're only going to get 80% of the amount that was calculated for the potential loan forgiveness. So it's not going to be 100%. And that's going to be further reduced by what's on this slide here is if you do reduce employees' pay. And I've had some clients come to me and say, I want to cover, I'm going to keep people employed up to 25 hours that are covered for health insurance, but obviously it's going to reduce their pay. Well, if that pay gets reduced by more than 25%, the excess over 25% will also be a subtraction from the loan forgiveness that will be allowed. The cancellation of the debt will not be included in income. So now when you're going to get the loan forgiveness, you need to talk to the lender. You have to apply for that up front. So when you apply for the loan through an SBA approved lender, typically banks, and a lot of the banks will have an SBA division that will handle SBA loans. You'll be negotiating with that loan officer. So all this information you'll be discussing with them. I've reached out to a couple banks this morning, in fact, and they said, please don't send too many clients yet because we're still not sure where this is all going to pan out. So again, the disaster loan is going to be through the SBA, and this standard loan 7A program is through a bank, an authorized SBA lender, and that'll be typically the bank. Next slide. So there are some of the states and some local loan assistance programs that are out there for you to be aware of. For instance, New York City will give a grant. Now, a grant you don't have to pay back, so that is free money. Any businesses with fewer than 5 employees they'll cover 40% of the payroll cost for 2 months. They'll get up to $27,000. Again, you're going to have to be in business for 6 months. You're going to have to prove that you have less than more than a 25% decrease in revenue. So again, your information that you're going to need. So talking to one of the partners at Withum, or if non-Withum clients, talking to the partners in the accounting firms that you are using, make sure that you have all that information available. You can't have any outstanding tax liens or legal judgments. They also have one in here for a loan for anybody less than 100 employees to get up to $75,000 at 0 interest rate. So, and I put a link here to the website to see that. So anybody on the call that's a business in New York City, there's that, you can apply there. Next slide. We have Philadelphia has a similar program. They have these three here that you see. They have a grant for $5,000, another grant up to $25,000, and then if your business is revenue between 3 and 5 million, they'll give you a loan between 25 and 100,000. Again, the website is on this slide, so you can click on that. If you have any questions, obviously give us a call, and we would love to help you with this. Next slide. We have Florida. And I tried to go to the big areas that I thought would have the most issues. And Florida, they have this business emergency bridge loan. They're accepting applications through May 8th, so you're going to have to jump on that kind of quickly. It's for businesses between 2 and 100 people. They're offering interest-free loans for 12 months. After the 12 months, the interest rate goes to 12%. So that's, again, what's happening here with this loan assistance program is really to get businesses through the next 4 to 6 months. It's not typically for long-term of financing and to grow your business, to get you through the next few months. The next slide, please. Los Angeles, again, they have a business emergency micro loan program. As you can see on the slide here, loans up between $5,000 and $20,000, 0 interest rate. If you pay it back within a year, you have the option to go up to 5 years, and they'll charge you 3 to 5%. There's no loan fees here. So again, and you got to prove that you're retaining jobs. So the key on a lot of these loans that are out there, it's a key is to keep employees in place. So you're going to find that on a lot of these requirements. Next slide is San Francisco. And here, they'll grant up to $10,000 to cover salaries and rent. It's for businesses with 1 to 5 employees. Again, have to demonstrate more than a 25% decline in revenue, and it's for businesses up to $2.5 million in gross receipts. You have the website there. The next slide is Massachusetts. Massachusetts actually had a program, and when the SBA came out with the economic injury disaster loan program, they kind of squashed theirs. So they said you can get the money through the SBA, so go there. So that one now is gone as of March 19th of 2020. Next slide is the New Jersey Economic Development Authority. And they've been in the news a lot with some of the growth programs that are out there. But here the governor signed into and has the power to make grants, which has been enacted. What's currently happening is that they're working through the scope of how this is all going to work out with the legislators. So the application process and procedures are going to be developed soon. So my recommendation is keep going to that website if you're looking for some funds there, and they'll continue, updating as they go forward through that. The last slide. And this last slide is just kind of information to get together that you'll need when you're going to sit down to start applying for these loans. You want to have your company formation documents. You want to have tax clearance. The EDA is going to require it, and most of the states will require that you're up to date on all your taxes. Payroll information, as we talked before, sales information, your revenue information for up to 3 years. You want to have the last 3 to 5 year tax returns ready. If you need financial statements, some of these require financial statements. If you don't have a financial statement, you may have to get a financial statement. So you want to talk to your accountant and try to start that process. With that said, I know I went kind of quick. If you have any questions, please let us know. So we'll go into the questions. Again, the last thing I want to say is our website has a lot of information, as Barry and Dan were saying earlier, and we're continually updating it as new developments occur. So constantly check that site out. So if there are any questions, Jessica, do you want to take over here?
We're going to get started with some that Dan received. Dan, do you have a few minutes? We also understand that we went over the time. So if anyone has to hop off, we're going to be sending out all of materials via email to everyone, as well as answers to a lot of the questions that came through. Dan, do you want to speak to a few of yours to start, and then we'll go through to the SALT questions and Frank's?
Absolutely. So there's a lot of questions here. I'll try and address some, then again, we'll get back to you later on the rest of them. Many of them are unanswerable. Unfortunately, we just don't have the level of detail that is necessary to answer many of these questions. But one is, does the extension apply to underpayments of estimated income tax? The answer is no. It applies to it gives you a payment extension to July 15th. That's it. And after that, if there's an underpayment, the typical rules would apply. So you think of it as just the due date extension for those kinds of taxes. Keep in mind, it's very rare, but an extension is only as good as the estimate provided on it. And if an extension is prepared with such a bad estimate, the IRS could say it's not a bona fide extension, and the extension itself isn't even valid if the taxpayer is trying to go beyond the July deadline. So there are those rules, the 90% rules, a payment safe harbor for the extension, but not a filing safe harbor. The next one is, does it apply to forms 5500? The answer is no. The list of forms is included. There's an explicit list in the Q&As, as we mentioned. 5500 is not one of them. Next question, gift taxes. No, gift taxes are not extended, so there's no extension for gift taxes. They are due on the normal time period, same as payroll, excise, estate, and gift. Here's one, what is the definition of quarantine or isolation order? Do shelters in place orders qualify, such as those in California? There's no definition yet of quarantine or isolation order. What I can say is, when you read those first three requirements, they all relate to the individual. So on the sick leave. So if the individual, I think they're getting at the individual subject to a quarantine or isolation order, not, is there a shelter in place or, shutdown order saying everyone stay in their homes. So I think that's our best guess at this point, is that it does relate to the individual, since that's the ordering of the rules. I'll go through a few more and then I'll switch it over. I know we're beyond the time limit here. Are both spouses eligible for family leave to care for a child? So the law, again, as you can imagine, is not clear on this. It doesn't say anything. If the parent believes they need to be home to care for the child and it's a legitimate request, the leave is covered. And that's all I can say at this point, since we don't have more information. But if there's a need for both parents to stay home, I mean, it certainly could exist in the case of a handicapped child with some kind of disability, then maybe it applies to both spouses. Allison?
All right. Yep, thanks everyone for attending today. And just a reminder, we're going to be sending out all the information via email of the materials, the presentation, the on-demand webinar, and some answers to additional questions. Thank you everyone for joining.